Let's dive into the 2008 financial crisis. It was a major event that nearly led to a global economic meltdown. Ben Bernanke, the former chairman of the Federal Reserve, even warned that it could have had disastrous consequences similar to the Great Depression. It's essential to understand what led to this situation to prevent such a crisis in the future.
To grasp what unfolded, we first need to understand mortgages. A mortgage is a loan people take out to buy a house. Traditionally, to get a mortgage, you needed good credit and a stable job. This was because banks wanted assurance that borrowers could repay the loan without defaulting, which would result in the bank taking the house.
To understand how the financial crisis escalated, we need to explore why investments in the U.S. housing market became so interesting. Investors looked at the housing market as a low-risk, yet high-return opportunity. Mortgages were attractive because of the interest rates paid by homeowners. These returns seemed better than other investments, like treasury bonds, which had low interest rates. This demand for higher returns led to the popularity of mortgage-backed securities.
So, what are these mortgage-backed securities exactly? They came about when big financial institutions decided to securitize mortgages. This means they collected thousands of home loans, pooled them together, and sold shares of this pool as investments. These securities became quite popular because they were seen as safe bets, given that home prices were consistently rising and the loans seemed stable. With the credit agencies' high ratings, investors trusted these as good investments.
Investors' confidence was bolstered by the AAA credit ratings many of these mortgage-backed securities received. Historical data suggested mortgage debt was reliable. This led to increased confidence among investors that housing investments were safe. People rarely doubted these securities, assuming the risk was minimal. If you'd like to explore these topics further, remember you can get our episode transcripts with a paid membership. Joining also supports our work.
Indeed, the combination of high demand from investors and reassuring credit ratings spurred a substantial risk-taking spree. Many investors believed the housing boom would continue indefinitely. This early confidence in mortgage-backed securities created a bubble of optimism around the housing market. As everyone continued to invest, no one realized how fragile this setup was until it was too late, setting the stage for the crisis to unfold.
As the demand for mortgage-backed securities grew, it put pressure on lenders to create more mortgages. This led to big changes in how loans were given out. Many lenders started to loosen their requirements, making it easier for people to get a mortgage, even if their income wasn't high or their credit wasn't great. This marked the start of what we now call subprime mortgages. Essentially, these were loans given to people who wouldn't usually qualify for a traditional mortgage.
Alongside this, some lenders began to use predatory lending practices. This means they offered loans without checking if people could really afford them. They used no-income verification loans or adjustable-rate mortgages. At first, these loans had low payments, which seemed manageable. But as time went on, the payments increased sharply, creating a situation where many people couldn't keep up. This led to a lot of loan defaults as people struggled to meet their rising mortgage payments.
Credit agencies continued to use historical data to rate these investments. This gave a false sense of security to investors because the ratings suggested that these mortgage-backed securities and other related investments were safe. However, the reality was quite different. The riskiness of these investments was growing because more high-risk loans were included in the pools. Yet, investors trusted the ratings and kept investing, believing everything was under control when in truth, it was becoming increasingly unstable.
This misjudgment by credit agencies contributed significantly to the looming crisis. They didn't adjust their models to reflect the true risk of the new types of loans that were suddenly flooding the market. Instead, they relied on outdated data from a time when mortgage lending was more conservative and safer. Eventually, this unchecked risk laid the groundwork for what would become a financial catastrophe. The system was poised for failure, and everyone seemed blind to the dangers that lay ahead.
After understanding the rise of risky investments, let's now discuss how the housing bubble finally burst. The housing market was growing at an unprecedented rate. Home prices went up rapidly, and many believed they'd continue rising. This rush created an unsustainable bubble. People were buying homes at inflated prices, thinking they would only increase in value. But bubbles have a tendency to burst, and eventually this one did.
The consequences were severe once the bubble burst. Borrowers found themselves in a tough spot as they couldn't meet their mortgage payments. Many defaulted, which meant more houses were put up for sale. But with few buyers, the supply of homes skyrocketed while demand dwindled. This scenario caused home prices to plummet. Suddenly, people owed more on their mortgages than what their homes were worth, which added to the financial strain for many.
As housing prices fell, the impacts weren't limited to individual homeowners. The ripple effects were felt across the financial system. Loans that were once solid investments became unstable. Financial institutions faced significant losses. With a glut of homes on the market and prices falling, the value of investments tied to these homes, such as mortgage-backed securities, also decreased. This sharp decline in home values and loan securities was a critical turning point leading to further economic challenges.
These developments caught many by surprise. The bursting of the bubble marked the beginning of a major financial collapse. Investors who had bought into the idea of never-ending growth suddenly faced losses. Lending halted as confidence in the housing market and associated securities dropped. The severe drop in housing prices not only threatened the housing market but also the broader financial world, setting the stage for a deeper crisis in the economy.
Let's transition into the realm of financial derivatives, a kind of investment that played a crucial role during the financial crisis. One such instrument was collateralized debt obligations, or CDOs. These CDOs were bundled investments that included various loans, including some very risky ones. At the same time, companies like AIG provided credit default swaps, which acted as a sort of insurance on these CDOs, but they weren't prepared financially when things went south.
The issue with these financial products was that they created a vast and complicated web of risks. These instruments were so intertwined that when the value of housing collapsed, the effects were felt across the entire financial system. Major players in finance began to declare bankruptcy because they couldn't meet their financial obligations. Each bankruptcy added more chaos, making it a challenge to identify which firms were stable and which were not.
This uncertainty and complexity caused a broad panic in the financial markets. As mortgage-backed securities and CDOs lost value, financial institutions were unsure about the real value of their assets. The credit markets froze as a result, making borrowing almost impossible. With credit lines drying up, businesses found it difficult to operate, leading the U.S. into a deep recession. This panic was unlike anything seen since the Great Depression.
The sudden stop of credit flow didn't just affect large banks, it hit everyday businesses and consumers hard. Companies couldn't secure short-term financing, leading to layoffs and a drop in consumer spending. The economic downturn spread quickly, showing how interconnected our financial systems are. The crisis revealed many vulnerabilities within the global economy and highlighted the need for change to prevent future calamities of this scale.
The government had no choice but to step in as the crisis unfolded. The Federal Reserve, which is the central bank of the United States, acted fast to offer emergency loans to banks. This move aimed to prevent the collapse of banks that were fundamentally sound but struggling due to the panic among lenders. It was vital to restore some stability in the system.
Along with the Federal Reserve's intervention, the U.S. government introduced a significant program named TARP, or Troubled Assets Relief Program. This program was initially designed to use $700 billion to stabilize the banks by buying their troubled assets. It ended up using $250 billion of this amount directly to bail out those institutions, which incredibly also extended to automobile makers and AIG, the big insurance company.
The government didn't just stop at bailing out the banks. They conducted stress tests on big banks' finances, involving detailed checks of their balance sheets. These tests aimed to reveal which banks were strong and which needed to raise more money. Knowing which banks were stable helped to ease fears and encourage lending again. Once the test results were public, it reduced the uncertainty and brought back some level of confidence in the market.
Additionally, in January 2009, Congress approved a vast stimulus package worth over $800 billion. This package involved both new spending and tax cuts, aiming to pump money back into the economy. The goal was to halt the rapid decline in economic activities and support job creation and spending. Thanks to these efforts, the financial panic started to slow down, helping to keep businesses and the broader economy from falling further.
Reflecting on the 2008 financial crisis, we see that the system had many flaws, especially in how incentives were structured. Mortgage brokers, for instance, got bonuses for lending out more money, which led them to prioritize quantity over quality. This pushed them to make riskier loans, not considering the long-term effects. This behavior is a prime example of something known as perverse incentives, where the effects of a policy contradict its goals.
Connected to this is the idea of moral hazard, where people take extra risks because they don't think they'll bear the full consequences. This was evident in the willingness of banks and lenders to provide loans to risky subprime borrowers. They planned to sell the mortgages to someone else, effectively passing the risk along the chain. It also relates to the principle, too big to fail. Banks were endorsing risky moves, believing they would be bailed out to avoid economic turmoil.
In response to these problems, the U.S. made changes in its regulatory framework. A significant step was the introduction of the Dodd-Frank financial reform in 2010. This law aimed to lower risks in the financial system by boosting transparency and limiting excessive risk-taking. It set up a Consumer Protection Bureau to keep an eye on lending practices and mandated that financial derivatives be traded on public exchanges, improving market transparency.
The Dodd-Frank reform also included measures to ensure that large financial institutions could fail without wreaking havoc on the economy. These measures sought to prevent the too-big-to-fail dilemma by allowing controlled failures of large banks. However, there's still debate about whether these regulations are enough to prevent future crises. Although progress was made, it's crucial to stay vigilant and continue to enhance financial system safeguards. If you enjoyed our talk today, please remember to give us a like and leave a comment. Your feedback means a lot to us. Also, if you wish to get transcripts of our episodes and support what we do, consider joining our community by clicking the Join button. We appreciate your engagement and look forward to having more insightful conversations with you.